live on BTFDtv. My name's Jack, and I have the one, the only Mr. Chess himself with us. Uncle Bob was going to be hosting this, but we appear to be having some technical glitches. So we're going to be talking for a few moments, and then we'll check to make sure that all the tech is working correctly. Chess, welcome back. Why don't you start a opening monologue?
All right, Jack, great to be here. Thanks again for having me. Always love coming on BTFDtv with you or Bob or anyone really, but obviously I know you guys done a great job with it. Basically, I know we're kind of winding down here on a summer Friday, but the theme of my blog post and my work of late, when we were talking about inside the services, is that this particular pullback in the market, it's always tough to gauge sentiment. It always seems very anecdotal, especially in this day and age, social media. There just seemed to be maybe just the setup for us to come in maybe a little bit more, I think, than some people would have thought. I mean, the S&P technically was coming into its 50-day simple moving average, that big, round, psychological 2100 level. And there was this idea out there that, you know, we had all these big earnings beats, and we have. I mean, with Amazon, Google, and you go back there, you know, Visa, Starbucks, this idea out there that the market was inevitably going to find strong hands or buyers down there. Now, we still can't. Today might have been some kind of summer Friday undershoot or something to that effect before we go screaming higher next week. But the reality is, and this is the way we've been kind of thinking about the market, this analogy of the S&P has been in a range since February of this year, and here we are in the final days of July. It's almost like you're stuck in this city, and each time you try to leave city limits, whether it's northbound to the upside with a breakout to the upside, or southbound with a breakdown to the downside, at the last minute there's always this hesitation, and back we go inside city limits. And that's kind of, I think, what's happening here. And yeah, the NASDAQ did make a new all-time high last Friday and even spilling over into Monday of this week, but it was kind of ephemeral in the sense that the gap higher above 5163 on the NASDAQ was faded. So I know I'm throwing out a lot of technical stuff, but basically the essence of what I'm saying is the major indices, the averages, are still largely range-bound and have been for at least a couple of months. Some have been since the spring months, and some have been since the winter months, and some of them, like the Dow Jones Industrial Average, you know, that big mega caps, stodgy mega caps, have essentially been range-bound since late November 2014, which is really incredible to say, Jack, considering August is right around the corner, right?
Right. Yeah, we're actually starting to plow through this year now. And there's no signs of change.
Exactly. I feel like bulls and bears alike, or just you keep waiting for this next thing to happen, right? This next big breakout to 2,400 in the S&P, or this next big bear market to materialize and come to fruition. And the reality is it's like this huge cliffhanger or tease, if you will. So.
Well, I'll just give my own personal example. I'm in my IRA account, right? I'm holding 21 stocks, but I'm 80% cash. And because I'm waiting for the pullback to put capital to work, or at least a breakout to buy, I would rather sit in cash until I get confirmation one way or the other.
Yeah. And I think, I think in this day and age, especially of Twitter finance, there's this counter argument that you can't, you know, you got to try to front run the move. I mean, you can't be late to a move. I mean, you got to get out in front. And I think a lot of people do that with options and levered instruments, and it's a risk. It's the quintessential high risk, high reward strategy. And I think you're seeing. I do think that's one reason why I think you're seeing the things slow down a little bit in social finance. I mean, you go through these peaks and valleys, I think, where you can just see the raw emotion of speculation, gambling, if you will, where things get really giddy, and I think a lot of it has to do with how the options market is pricing and working and that sort of thing. And the big moves we've seen in Google and Amazon may very well be masking, I think, some of the damage below the surface at this point. I mean, you actually have the Dow Jones Industrial Average following the Dow Jones Transportation Average, both below the respective 200-day moving averages, and the NASDAQ Composite Index just made a new all-time high, surpassing dot-com bubble highs this week, Monday of this week, which is, I mean, you're not going to see that too often in your career, frankly. I mean, I've been saying this for a while now, admittedly, but this is classic bifurcation. And you're always going to have winners and losers in capitalism. I mean, you know that, Jack. I mean, you're always going to have winners and losers in capitalism. But it's the circumstance and it's the extent to which you get to those winners and losers, the spreads, the bifurcation, very, very strong, very, very weak. That's where you get to a little bit of an unhealthy, unsustainable circumstance. And the reasoning for that, it's not just technical mumbo jumbo or voodoo. The reason why it becomes unhealthy, the bifurcation, very, very strong. You know, Google, Netflix, Amazon, very, very strong, and then very, very weak. The reason why it's unhealthy is because the market essentially loses its focus, its discipline. You get fund managers piling into the big marquee names, and then you have everyone leaving the losers on the side of the road, right? And so typically you get eventually, and this cycle's been unique, I think, in the extent to which it's gone on, but usually you get to this rubber meets the road moment.
Here's just an angle to look at, and it actually overlays with what you're saying. You could point to the venture capital markets as an example of that right now. You have unicorns, right? The billion dollar instant companies that can IPO, but the era of IPOing small, successful companies hasn't been happening. And there's a whole bunch of VCs who have invested in a whole bunch of babies, and there's no exit strategy now because we're not IPOing 5 stocks a day anymore, right?
Yeah.
And so there's panic in the VC world now as they're looking around, and do you have a unicorn to bail out your liquidity? Because you've invested in all these other companies that may or may not ever make it to market because we've changed how we take companies to market.
I completely agree. I think this cycle and the structure of the current market is unique. I mean, with the way everything's going on, and I've been saying this idea of a rich get richer kind of market, right? Where obviously it not just the Amazons and Netflix and the Googles, but the biotechnology stocks, the healthcare stocks. And I live in an area where there's many healthcare and biotech firms, prominent firms. And I mean, for what it's worth, I mean, it's a summer Friday, so I'll just throw this out. Anecdotal. This is classic anecdotal evidence for anyone listening. That's all it is. It's not actionable per se, but it's something of interest. I spoke to one of the managers at a kind of a high-end steakhouse around here, and where many biotechnology and healthcare executives frequent, taking clients out to dinners. And what I'm being told now is after many, many months or even a year, let's say since 2012-13, of spending lavishly, all of a sudden now a lot of these biotechnology and healthcare executives are they're either issuing or they're under strict orders themselves to, let's say, not spend more than $100 on a bottle of wine, let's say. So I know that sounds like a classic top, 1%er kind of language. Don't spend more than $100 on a bottle of wine, but there's starting to be a little bit of pushback. Yeah, exactly. Maybe a smidge of a pushback on this idea of the biotechs being in the go-go days, in this golden era of biotechnology, that we're in the first inning of a biotech bull market, and we might over the course of this century, but over the course, let's say, of this decade, are we in the first inning of? I have to think we're a little further along than that.
Sure, no argument on that one.
So I just thought that was an interesting little Friday summer tidbit that, you know what I'm saying, Jack? Like all of a sudden you're seeing this pushback. Maybe you could see there's this last minute hesitation on the part of some of these firms that, okay, maybe we shouldn't jump the shark in the way the dot-com bubble guys kind of did, right?
Right. On my stream, I've been watching the VC side talk about their view of their market. And I look at the VC market as the prelude to our equity markets, right? So that's why I'm pointing here, because these are the kids that we're supposed to be playing with the next few years from investment perspectives. And they have raised a bunch of cash, and now they're talking about tightening burn rates so that they can ride out this period coming up where there won't be any love in the market for them. You know, quite frankly, have you raised money? Do you have enough money to last for the next 3 to 5 years? Those of you who have high burn rates, you're not going to make it. So that's why I'm going there, is that there's belt tightening happening at the pre-stages. And I'm wondering when we're going to start seeing the belt tightening in our equity markets.
Yeah, usually, well, I mean, I think there's a stereotype that the equity market is always the last one to get it, to know.
Right. We're the dumb kids. Sorry.
Exactly. Like the dumb younger brother of the credit guys. That the credit guys are so rigorous, you know, and they're like these really sharp wolves, and they're on it, and they're. I mean, and I think there's a lot of truth to that. The whole idea of the wolf pack, the vigilantes, and the bond market. And I think there's a lot of truth to that. And the issue, I mean, you take a look at junk bonds and high yield corporate paper, and I know a lot of them are overweight energy. Like, I know all the counter arguments at this point. You know, you can't focus too much on junk and high yield corporate paper because they're energy focused, and the energy thing is contained. But then you take a look at the transports, and you take a look at even the semiconductors, and you're starting to see it. You're starting to see it metastasize a little bit. I mean, you are. I mean, you're seeing things spread. It's not just energy, this energy material kind of focused bear market. Everything else is peaches and cream. I mean, you are seeing, I think, at a minimum.
Intel's an example there. Moving to our you know, the large ones here in our economy. Intel missed one of its major deadlines. They're not going to shrink down in time. They're going to extend the current gen. They're having Moore's Law issues. I'll put it in those contexts. And additionally, they're looking around, and there's no demand for the old workstation CPU model. And the millennials have moved to cell phones, right? So there's this scenario where the big guys who should be putting big capital to work, preparing for the next generation, are looking around going, we haven't used up the capacity we have. Why invest in tomorrow now? And I think that'll have implications as we go forward.
Intel's a name I've been short the last couple of days, and yeah, I mean, the semiconductors, it's a question of masking. I've kind of alluded to that weird, bad, kind of good movie, that Tom Cruise movie, Eyes Wide Shut, you know, and I think there's a lot of that. There's a lot of Eyes Wide Shut happening right now in terms of market commentators and pundits because of how resilient this bull market's been. Each time it looks like we have all the hallmarks of a real correction, not even a bear market, just a real kind of reset. Let's just shake the tree and shake out the weak hands and all that. It hasn't happened. So we haven't had, I think, something beyond a 10% correction on the S&P in several years. And I think that kind of lends itself to a certain mindset where you just kind of cast aside any of these divergences, that it just can't happen. But again, there's a lot of eyes wide shut. Intel is a problem. And I think the strength in names like Umbrella and Skyworks and some of these semiconductors of late, and I know Skyworks is doing a classic green to red reversal after earnings, I believe, today, and could be actually topping itself, but still, the strength in Disney, Starbucks, Nike, I mean, there's more than enough individual kind of names to point to, and in the healthcare and biotech can just say, look, you know, you can't be bearish. You can't be cautious because look at the leaders. Leaders lead. And I think you could have said the same thing. And I mean, that generally is the rule, but you take a look back at October 2007. I mean, you know, Jim Cramer, I mean, I'm not critical of Cramer. I mean, I think he's a legend, but he did have, you know, the four horsemen back then. It was something like Apple, Google, Baidu, and Amazon, I think it was. And this was September, October 2007, like literally right as the market was topping, and these names actually rallied. Some of them, like Apple, even rallied well into 2008 at various times. But so sometimes my point is the leaders do deceive you every so often, and I think it's something to not necessarily bet the farm on, but it's something to keep an open mind to. That just because Amazon is going to the moon, and Google went to the moon and Netflix, it doesn't necessarily mean that everything else is going to follow suit. That happens a lot, more often than not, but it doesn't always happen. And that gets to the whole idea, I think, of being a speculator and risk to reward and considering the odds, and do you really account in your risk to reward profile for a certain outcome, especially if you're betting big and especially if you're using leverage like options. I think it increases your risk of ruin, I would say, especially some of the newer traders out there who haven't experienced a bear market or deep correction.
I agree. So what are you looking at right now going forward?
Right now, I'm looking to see at what point will the strong parts of the market, the really strong parts of the market, will they start to kind of? I'm looking to see if they're going to continue to be exceptionally resilient on this pullback, especially what we've seen out of the biotechnology stocks. We have Biogen. Obviously, Biogen's been lagging, but some of the monsters like Gilead. Is Gilead just going to come in? It's down 4% today. Is it going to just come in today and stem the tide and then regroup and move higher? And if it does, then I think what I just said applies to the other side of the tape, to bears. You can't lose your discipline there, especially. Then we're still on the cusp maybe of another leg higher in a resilient bull market that's legendary. Okay, so I'm looking to see, will the biotechs and the healthcare stocks, will they immediately regain their footing? Financials, the XLF.
By the way, you picked out my most painful position in the port today, so just well called there.
Okay, which one is what, Gilead?
Yeah.
Okay, I'll stop talking about Gilead. But
no, it's okay. I'm just that one actually is how do we say, bleeding the most on the table.
Yeah, well, you're just helping the local. That's what in Las Vegas they say when you go gamble at the local casino. You say you're helping the local economy out.
Yes, it's
at the Hard Rock Casino. But the XLF, the financial sector ETF, is back below its primary breakout point from I believe Friday, July 17th. So again, I'm looking to see, will the recent strength we've seen there, will the leaders, it's not so much to me, as I mentioned in the blog post, it's not really about Amazon per se, because Amazon and Google, they're kind of doing their thing. I know Google gave back a chunk from where it was, but it can do that as long as Google holds above, let's say 604.50, way down there. I mean, or something to that effect. I mean, I think Google's okay here. It's not really about Google and Amazon per se. It's about the way the market's constructed, to me. And will the really, really strong parts, will we get that bifurcation, that classic bifurcation, rubber meets the road moment, where the really, really strong parts and then really, really weak parts, the transports, energy, materials, even semiconductors now, let's say, will they kind of, even if they can bounce around a little bit, you can trade them for little bounces, but will they stay relatively weak, the emerging markets, and then will the strongest parts break off? And when that happens, typically it ends very badly. Junk bonds, high corporate paper, all that. You could even look across other markets. The euro, I think, is an interesting juncture. If the euro dollar cross can't reclaim 1.10, something to that effect, I think that's going to be an issue going forward as well too. The euro weakness potentially into the end of the summer. I do think the whole idea of parity and everything like that with the euro dollar, I think that's going to become much more of a pronounced issue into the fall. I think my best guess is, to answer your question, is into the autumn months after Labor Day, once everyone comes back from the Hamptons and everything like that. I think we're set up for a really interesting autumn. I think it's definitely not a time to kind of walk away from your screens after Labor Day.
I got a bifurcation example for you, and I'd love to have you evaluate it.
Yeah.
These are two numbers since June 15th. Okay. Since June 15th, Apple is down 1.3%. Since June 15th, Facebook is up 19.8%.
Apple versus Facebook?
Yeah.
Yeah, that's and then Facebook's got earnings coming up, right? So I think Facebook is going to be interesting. I think the Facebook earnings I guess the easiest thing to do, I guess if I were a new trader, the most tempting thing to do right now would be to buy a lot of Facebook calls, right? That's almost like the hanging. It seems like the low hanging fruit at this point. Facebook, just like Amazon, just like Google, just like Netflix, has run into earnings. I mean, just like Chipotle, and I guess the most obvious. I don't know if this most. I don't know what the listeners out there think, but it feels like the most obvious trade in the world is to just bet it, do it, to just go for it, double down on Facebook calls, 100, strike, something like that. And I'm wondering if that might be like a tipping point, so to speak, where maybe it doesn't happen. I mean, I'm not much of an earnings gambler, but I'm just kind of thinking out loud as far as that's concerned. And then Apple, Apple has seen, I think Apple saw that rally in 2014 into let's say the first month or so of this year, where it kind of defied the law of large numbers, because you'd expect that to eventually catch up to a company like Apple. And to me, it's not even really about the iWatch or anything like that, whether it's a flop or whether it's the next big thing and no one knows it yet. To me, it's just about Apple. Eventually, the law of large numbers, I think, catches up to a company like Apple, and eventually market forces and I think and competitors and everything like that's catching up to Apple. And Apple, I think,
what's it saying? You can only win the game for a half a decade.
Yeah, exactly. And I think there's something to that, what you just said with Apple. I do.
Well, let's call it a decade. Microsoft had theirs. Apple has had theirs.
Yeah.
So roughly a decade. Google has overlapped.
That's true. And Microsoft also, I think Microsoft also, but to your point, Jack, I think if Microsoft was coming to age, let's say, I know it's still around, obviously, but if it was coming to age with Bill Gates the way it was back then, in this cycle, I think it'd be different. I agree with you, though. I think what you just said, that maybe a half a decade would be much more apropos. I think the fact that Microsoft came of age during that great 1982-2000 secular bull, I think really, that kind of goosed it, in my opinion, a little bit,
Agreed.
So, it didn't hurt, put it that way. It didn't hurt.
Never. All right. I'm going to just start tossing out some at you just to see what you think, and the sector too. In the basic materials, obviously there's a dead zone of former players. There's some refineries, though, that don't have to pay as much for their inputs, and they're enjoying some crack spreads. Example is Marathon, that's up roughly, 10% plus since mid-June. Thoughts on that?
Yeah, I think there's also Tesoro, ticker symbol TSO. That's actually like a solid chart. Yeah, and I do think Marathon, Marathon's come in of late from what I'm seeing, but Valero, Tesoro, refinery, but I think Valero and Tesoro, especially VLO and TSO, they've been pretty impressive, I would say.
I think they got really hot about the time I moved them out and moved Marathon in, just context.
I see what you're saying. Yeah, refiners have always traded like in their own world. I know there's always like a backstory with them, in terms of crack
spread.
Yeah, but when I see the way they trade, they always just do their own thing. They just don't care. They're basically like the kids in high school that just walk around with the leather jackets and the slick back hair. You know what I mean? And they do whatever they want. If they want to have fun and be cool, they'll do that. If they want to slam a dork against the locker and take his lunch money, they'll do that. Refiners have always traded that way, and I think I'm harkening back to 2007, and if I recall, they were doing the same kind of things just back then. They kind of marched to be their own drummer.
Hey, it looks like one of our Biotechs that was frozen is unfrozen. What is that? Let me look at that symbol. Hold on. RGEN.
Yeah, there was. Was that Repligen? Oh,
yeah.
No, REGN, Regeneron.
Yeah.
Yeah, that's another monster biotech leader. Just like Gilead, it reminds me of Gilead a lot. Like Gilead and Regeneron, and I know Celgene came on late with the deal, the pop after that deal, but Regeneron and Gilead really were the kings of the castle there for a while, taking over the baton from Biogen after Biogen started to slip. And Regeneron's another one. When you back out the chart, it's not unlike Nike. I mean, these are companies which obviously have a lot of institutional sponsorship, a lot of market capitalization, and they're premier brand names in their fields. And that gets to the idea of bifurcation. Because if you just do a chart-by-chart comparison of Nike versus, let's say, Caterpillar, it's incredible when you see that. I mean, Nike versus Caterpillar, it really is something to behold. You know, very, very strong versus very, very weak. And that, again, that's the circumstance of bifurcation. You're always going to have winners and losers in market capitalism. It's just a line drawing question, the degree in which you get there.
Last tech stock to bring up, Cisco. What the hell is with Cisco today? Is there a major fund that's unwinding its shorts? Yeah,
that's interesting. Up 1.5, a gap up 1.5% today. I mean, Cisco.
I mean, literally, that's the one that I always look at Cisco as a bellwether rollover stock. I know that's bad to say, and I have exposure to it, so I'm long to it, to be honest. But I use it as a canary, right?
Absolutely.
So I expect to do is see the canary up today. I'll just put it in those terms.
I agree. Yeah, this Cisco's always Cisco, and I think to a lesser degree Microsoft, but Cisco is notorious, to what you just said, for giving that kind of final head fake in a bull market. I'm not saying it's doing it now, but in September, October 2007, CEO John Chambers famously said in a conference call, it was the best environment he's seen in 25 years. And then, I mean, you know, I'm not trying to take a shot at John Chambers, but you know what I mean. Like,
no, you should. Yes. Continue on.
I mean, yeah, and a lot of guys ran with that and said, well, look, you can't be bearish. John Chambers knows what's going on. He sees everything. You know, he's the chief executive officer of Cisco Systems. I mean, how can you possibly defy that when this guy sees everything around the world every day, and he's sitting there saying it's the best environment in 25 years, and then we had a an epic bear market. I mean, it's going to happen. I mean, that's just part of the game. You just have to acknowledge that there's never going to be that crystal clear tell, per se, where you can say, aha, that's it. You know, I know everyone has, you know, the father-in-law or the brother-in-law or a friend who, like, aha, that's it. That's the market top. Or, aha, we're still climbing the wall of worry because this guy is still bearish. But, you know, the reality is those might all be red herrings, especially in this day and age in social media, because, you know, someone like me, for example, I put my work out there, and I can be 100% wrong and not only not lose money, but potentially make money on a trade if I'm willing to just trade what I see and go against a bias. And so you can have an opinion, and someone might be keying off your opinion because they think you're a good contrarian indicator, but I might be doing something completely else in a New York minute if I determine that's the right trade to make. So that's one thing I would caution against new traders as well, is trying to find that holy grail contrarian indicator. I know it's really fun to do that because
we all have two or three.
Yeah, it's really fun to try to realize. I think there's an old saying that poker players like to realize that they've realized something, right? When you have that epiphany of the epiphany, it's almost like you start to really pat yourself on the back and say, I just figured out, you know, when he twitches, when he shakes his vodka tonic with his left hand, that means he has pocket aces, right? And you feel so good about it for realizing that. But the reality is, I mean, if you're a serious trader, you know, I mean, you got to kind of not get carried away with that.
All right, I'm gonna cough up my most painful position. We'll just call it the biggest hole in the ground at the moment. Taser, is it done? Do I tap?
Well, I believe Taser has earnings coming up, right? I think I tried Taser myself.
They've been breaking down lately. and have quickly gone from a green position to just about at its limit out.
Taser, I would say, still, it's still overall, I would say, broadly in an uptrend. I mean, you could be seeing a head and shoulders top since May on the daily chart, but my best guess, Jack, is that I'm just trying to
Just
double.
Patience, Jack.
Well, I'm just trying to double. Okay, earnings are July 30th, from what I can see.
Okay.
So we got earnings coming up. I guess next Thursday. That to me is probably going to be, the tipping point, one way or the other. I mean, as long as it holds, I would say this 29 area. I think it's okay. It's probably just consolidating. But yeah, my best guess is earnings, and the reaction to it should be dispositive or that kind of thing.
Okay, thank you. All right, we've been chatting for a good 30 minutes or so. Anything you want to hit on specific before we call it a day and end a week?
Are we getting any kind of audience out there?
Yeah, we've got a very stable audience. So the audience is not like falling off or anything.
Yeah. Well, I'm looking at the steel names too. Letter X. I mean, that's been pretty bad. And of course, you have coal names, which are really kind of.
Coal still trade in America? Aren't they like on a Chinese index that stopped or something?
Yeah, I mean, I'm wondering if West Virginia is going to be part of China at some point. You know what I mean? Like, it's not good. I mean, the coal route, every time I think myself and like any other kind of like momentum technical guys out there in the last like 2 years have looked to trade coal stocks. Each and every time it seems like coal stocks were ripe, even for just a tradable 2-3 day snapback rally. They have slipped on the banana peel, and it's really incredible. You look at Peabody Energy, BT, ticker symbol BTU. I mean, again, that goes to the idea of bifurcation, and it's typically a serious circumstance. Again, this cycle has taken a long time to play out, whether it's because of zero interest rates or whether it's because of the wall of worry. I don't think anyone knows for sure. I know people love to pontificate about that, but I think in the end, it's going to be interesting to see how the market resolves or comes to terms.
Look at that chart on BTU.
Yeah.
I used to like BTU 10 years ago. Obviously, there was a different administration in at the time.
Yeah, yeah. I mean, it's. I think that politics might have something to do with it, but I mean, yeah.
Damn, $300 million market cap.
Yeah, and you have to ask yourself, I mean, you would probably know this much better than me, Jack, but the liquidation value of some of these coal companies, their machinery, the irony is their machinery is and everything.
It's worth billions.
Yeah, I mean, so it's so out of control, like the way these things are playing out here. It's almost scary, just the way in which the market is being so ruthless.
Well, part of the issue, though, is that there's no love anywhere in mining. So it's not like you can easily even take a BTU, turn it off, liquidate the mining equipment to somewhere else. Take a look at what's happening in Canada. And there's going to be a whole bunch of oil sand projects that were not fully prepared for this pricing that will have to be mothballed. And capital already expended is going to have brand new dump trucks that aren't going to be needed for a period of time. I'm trying to put it in those terms, right? So I can see a scenario where the mining equipment market could very easily be flooded with low miles or no miles equipment.
Yeah, that's I could definitely see that. That's yeah.
That's normal in Caterpillar is what I'm getting at.
Caterpillar, and then you take a look at Alcoa. Here's another. I mean, if you look at that Alcoa chart, Jack, I think you'll be incredible.
Oh, yes, that's another one of those. Hold on a second. I'll just pull it up so I can look at it. I'm using my Gitto AOM system, so I'm looking at my data points internally, and that is one of the most beautiful shorts since May.
Yeah.
Ever.
And then, you know, the funny thing about that is you have to ask yourself, how many, you talk about barriers to entry, right? Warren Buffett, is there a moat around your business? How many major aluminum players are there in the world? Like, what, 3 or 4? And yet the market just doesn't care. The market is going to take this thing down, and without, you know, without any, with no mercy, really. I mean,
Well, what is it? The most it's had is 2 up days at any point since May.
yeah, which is just incredible, because at one point, Alcoa became this, like, you know, chic, like in late 2013 into early to mid 2014. Alcoa became like chic bottoming play. Well, you know what I mean? And now it's giving up, I would say, about, you know, 3/4 of that rally, and it's at a real interesting juncture here. I mean, net, it's still basically dead money since it crashed in 2008, where it went from really went from 40 down to 4 or something like that, a 40 handle down to a 4 handle in 2008, which is incredible. Again, considering it's a major aluminum player, and there, you know, plenty of barriers to entry. It's pretty incredible.
It still has 12 billion in market cap, for context.
Yeah.
Hey,
So
we had a hard glitch. It kicked me out of the room. It brought me back, and now I don't know if we're still live or not, just so you know.
okay.
So I don't see a mark. It says we're live, but I don't see a marker that shows any audience at this moment.
Oh, okay.
So why don't we call this a Friday afternoon? And I want to thank you for joining us and returning, and maybe we can do this next week again.
Yeah, hey, Jack, my pleasure. I love coming on whenever you want. Just let me know, okay?
Sounds like a plan. People, if you still see us, thank you for joining us. Have an absolutely great weekend, and BTFDtv will be there, even if it's all the fucking rip. Have a good one.
All right. See you next.